Good morning, ladies and gentlemen. A very warm welcome to GAM's Global Investment Conference. After 25 glorious years, the question is, has the golden age of finance collapsed? Last year, we saw the biggest federal government bailout, the biggest bank rescue, the biggest insurance company rescue, the biggest US bankruptcy, the biggest shift in interest rates to the lowest level in the Fed's 94-year history, the biggest proposed fiscal stimulus package, and just to top it all, the biggest Wall Street fraud. The credit crisis marks an end to one of the longest periods of easy credit and high profitability ever seen in the financial services industry. What is old and what is new about the causes of the turmoil? What is simply a cyclical readjustment of valuations, a repricing of risk, and a shift in credit supply? And what represents an end to important secular trends in asset prices, financial innovation, and government policy? After the massive bull run of the last 7 years, it was easy to forget that financial history is a roller coaster of booms and busts, ups and downs, bubbles and crashes. All too often, commentators like to say, it's a new paradigm shift and this time it's different, when usually it's just more of the same. But perhaps this time it really is different. Just look at the scale of the crisis, the breadth with which the deleveraging is unfolding across the world, and the speed, the size, and complexity of the government response. We've seen $30 trillion wiped off global equity markets. That's $30 trillion of wealth destruction, plus trillions more lost in real estate, corporate credit markets, and private equity. Let's just try and put that number into context. In 2006, total global economic output was $47 trillion. Total value of stock and bond markets globally combined was $119 trillion. The nominal value of derivatives was $473 trillion, which is 10 times global output. Is that really sustainable? And just for comparison, when the tech bubble burst in 2000, markets lost only $9 trillion. In his major investment classic, Manias, Panics and Crashes, Charles Kindleberger listed 38 major financial crises between 1800 and 2000. That's one every 5 years and 3 months. And in fact, despite, or should I say, because of our ever more sophisticated modeling techniques, crashes have actually occurred more frequently in the last 30 years. All financial crises are rooted in human behavior, frenzy caused by greed and typically fueled by cheap money. And whilst the objects of bubbles have changed from exotic tulip bulbs to canals to cotton, tech stocks, real estate, commodities, today's crisis cuts to the heart of the international financial system and hence to the heart of economic activity. And that's why its impact is so widespread now that globalization and securitization make the world so much more interconnected than ever before. Some commentators like to say it was one of Nicholas Taleb's black swans. It wasn't. It was a classic asset and credit bubble. The crisis was years in the making, fueled by a toxic cocktail of excessive consumption in the West, savings glut in Asia and other emerging markets, causing ultra-cheap paper money, which pushed down yields and risk spreads to unrealistic levels and fueled overinflated asset prices, with gallons of financial innovation to wash it all down. Sooner or later, like every other bubble, this bubble was bound to burst also. So now, after a 7-year bull market, we see full-flooded reversal of the cycle, with deleveraging, the return of big government, and no doubt, stricter regulation. So the question today is, how do bear markets end? And what are markets going to do this year? The economist Russell Napier, in his book Anatomy of a Bear, looked at 4 periods in history of extreme undervaluation: 1921, 1932, 1949, and 1982. And he found 3 areas which typically signaled the bottoming of a market. There's a recession. I think we can safely say we're there. There are extreme levels of price disturbance. Again, tick. Commodity prices stabilize. Not quite there yet. And what's so critical this time, the fuel for economic growth will be an end to the write-down and a recapitalization of the banks. Credit markets need to function normally again. Aggregate demand must start responding to expansionary government policy. Plus, it would help to have a healthy dose of Obama's positive and self-fulfilling, yes, we can. Of course, the dilemma for responsible governments who prefer to look beyond the next year or two is, how do you alleviate today's problems without creating further problems down the road? The Economist ran a great cartoon on this a couple of weeks ago. As I say, I think we've seen this one before. As in everything, markets present challenges and opportunities. The challenge is that we're facing a very tough economic environment, we're not yet out of the woods, and there is some way to climb. But whilst the short-term outlook calls for prudence, there are some opportunities which will come up over the next 12 to 18 months. We've seen the biggest and fastest market correction, and now that markets are undershooting, after years of overshooting, this means there's like to be a reversion to mean. Volatility is high, which is good news for our macro managers. The corporate space, selectively, offers some interesting potential. Dividend yields are greater than yields from government bonds. P's have fallen very strongly, which means that stocks are beginning to look cheap, even if earnings do come down a bit more. This is a market that will reward patient investors. Of course, the biggest challenge will be finding the right risk-adjusted opportunities, and GAM is very well positioned to do so. We've built a very robust manager selection and monitoring process, and we've shown over the last 25 years, in an environment of very large performance dispersion, that we do have the superior investment know-how, due diligence, and risk controls to pick some of the most talented managers, some of which are here today. We're never complacent, and we're constantly refining our investment manager approach in a constantly changing environment. So, where should you invest? What should you buy? What's going to emerge once the crisis is over? Will there be any changes to the structure of economic activity, or do we simply go back to business as usual? What will 2009 bring? This is really a great time to have a conference, and we've invited a panel of speakers who will present their views and to whom you can ask your questions. I'd like now to introduce David Solo, GAM's CEO, to answer some of these difficult and very important questions.